Hi students, today we will take an example of a stock in the auto ancillary space and show you how to analyze the stock from an education perspective. We will be covering several parameters such as business model, growth drivers, economic moat, financial strength, and risks and concerns. Let me first give you a summary of these factors. Ramakrishna Forgings Limited, RKFL, is the second largest forging company in India with the state-of-the-art manufacturing capacities in ring rolling, wedged press lines, and state-of-the-art machining capabilities. The company primarily caters to the automotive forging industry, especially in the medium and heavy commercial vehicle segment in both the domestic and the exports market. RKFL has an economic moat based on its locational advantage. It has multiple growth drivers such as reduced dependence on one segment and geographic location, customer and product portfolio widening, entry into electric vehicle products and cold forgings, investment in research and development capabilities, synergies from the acquisition of JMT Auto, and operating efficiency from the press line. Over FY13 to FY22, the company's revenue has registered CAGR of 21.4%, EBITDA CAGR of 25.4%, adjusted profit after tax CAGR of 41.3%. It has seen its EBITDA margin improve from 15.7% in FY13 to 22.3% in FY22. Driven by better demand from exports and higher operating efficiencies, its revenue and profit after tax would also improve further. Debt to equity ratio will also improve in the next few years. At the current market price of Rs 269, the stock is valued at around 11 times its FY24 estimated earnings by the analysts. On the valuation band, the stock looks cheap. Now let's look at some of the details of the company. Ramakrishna Forging Limited is the second largest forging company in India with the state-of-the-art manufacturing capacities in ring rolling, wedged press lines, and state-of-the-art machine capabilities. Machine capabilities include turning center, gear hubbing, shaping, shaving, and broaching. The company primarily caters to the automotive forging industry, especially in the medium and heavy commercial vehicle segment in both domestic and export markets. The company offers diverse products in categories such as front axle and steering, engine, suspension and chassis, transmission, and rear axle. Besides automotive, the products have usage in tractors and tillers, earth moving, and industries such as railways and energy. The company has 6 manufacturing capacities in India with sales offices spread across the USA, Brazil, Turkey, Germany, and Italy. It also has warehousing facilities in the USA, Mexico, and Belgium. The revenue breakup by geographic segment and industry is as shown on your screen. RKFL has location-based economic moat. Its facilities are located at strategic locations which are near automobile manufacturing hubs, exports hub, key suppliers of raw materials which have less chance of supply interruptions, lower logistics costs, and reduced working capital requirements. Further, all its facilities are located within the same region, resulting in efficient processes, improved coordination, and overall cost savings. The company has multiple growth drivers such as reduced dependence on one segment and geographic location. In this, RKFL is taking steps to diversify its revenue from auto segment to non-auto segment. Auto segment as of 9 months of FY23 contributes 79% of the revenue and non-auto contributes 21%. It is targeting non-auto revenues to reach 30% of revenue over the next 3 years. As of FY22, exports contributed close to 43% of revenue. Over the last 2 years, exports domination to the US is reducing, and it has reduced from 71% in FY17 to 59% as of first half of FY23, whereas the contribution of EU has increased from 4% in FY17 to 14% in first half of FY23. RKFL has also made inroads with other Tier 1 and OEMs in the EU and US. RKFL has a very high chance of scaling up the business with some of these OEMs. Customer and portfolio product widening. RKFL has reduced its dependence on one large customer from 45% to 22%. RKFL has added the largest US EU OEM Tier 1 player as its customer. Further, as China Plus One strategy can benefit RKFL with more customers from developed nations. The company is adding different size presses to expand its portfolio. It will add 56,300 tons of capacity, which will help it achieve a revenue of rupees 5,000 crore and give operating leverage for fast improvement in profitability. Electric vehicles and hot cold forging. RKFL is adding capacity for the hot and warm forging of 56,000 tons, which shall commence operations in the second half of FY24. This will take the total capacity to 243,000 tons. This will add close to 20% of capacity towards high value added forgings. The company is in discussion with the existing customers and has already won orders from US, EU and India. The management aspires to have 5% of its revenue originating from the electric vehicle segment. The company would also invest in research and development capabilities to further enhance its competitive edge concerning quality and cost. RKFL is in the process of acquiring GMT Auto, which has significant expertise in the auto and oil and gas sector, which will provide synergies to the company in this customer segment. With rising scale as well as focus on automation and robotization, optimal efficiency will improve and drive the return on capital employed of the business. Higher asset turns of the low capex automation plant will lead to better efficiency and enable RKFL to negotiate better prices. Also, the commodity pass-through will improve its EBITDA. Risks and concerns of the company are as follows: heavy dependence on auto industry, especially the CV segment, delays in the ramp-up of export orders, the inability to reduce dependence on one of its largest customers, and the lack of optimal utilization in the recent addition of plant capacities. Over FY13 to FY22, the company's revenue has registered a CAGR of 21.4%, EBITDA CAGR of 25.4%, and adjusted profit after tax CAGR of 41.3%. Its EBITDA margin improved from 15.7% in FY13 to 22.3% in FY22. Driven by better demand from exports and higher operating efficiencies, its revenue and profit after tax would also improve further. With a stable working capital cycle and benefits of earlier capital expenditure kicking in, the debt to equity ratio is expected to reduce in FY23. These factors will also improve the return ratios of the company. At the current market price of Rs 269, the stock is valued at 11 times FY24 estimated earnings. On the valuation band, the stock looks cheap. All this analysis makes RKFL a fundamentally sound company. Kindly note, we do not give any recommendations or advice. Students who wish to learn further can do their analysis or consult a financial advisor. This is Viral Shah signing off. Happy investing. This should not be treated as a recommendation. Please conduct your own analysis or consult a financial advisor before investing. Thank you.